Hello and welcome. This is BQ Prime. I am Agam Vakil. Well, the markets, for most of it, have run up quite a bit with the benchmark, that is the Nifty 50, making a life high last week. And, well, the mid-cap indices have just run out of sight. But we are going to take stock of where markets stand now. We are going to try and look forward as to how markets can potentially behave, keeping in mind especially the last few months. And of course, we'll also talk about the implications of the current state of the economy as well as corporate earnings on Indian equity markets. But for that, let's welcome in a veteran in its very true sense of the word, Mr. Nandan Chakraborty, who heads strategy at DAM Capital. Mr. Chakraborty, good afternoon, and thank you so much for joining in. I was going through one of your more recent reports, and you actually start by talking about whether or not the markets are in a bubble. More importantly, you also draw a very interesting parallel between our markets and the behavior of the Indian Rufus treaty. Would you care to explain?
Sure. So basically, the Indian Rufus tree pie is basically known as the tiger bird or the tiger dentist. So for thousands and probably millions of years or whatever, it's been a synergistic relationship between the tiger and this particular bird, which has the same color as the tiger. The skin color is the same. And what happens is after the tiger has its meal, it opens its mouth wide, and the tree pie pecks the morsels from its teeth so that the tiger's gums don't suffer. Essentially, what I've tried to point out in this is that tiger's mouth is open now, bull market is on. Nobody knows when the bull market will get over and it will become a bubble and the market was closed. So it will be very exclusive in what you pick. So I think that is the sort of overall image that I wanted to convey in the strategy report this time, which is to be careful and exclusive in what you pick, because it's not a bubble yet, but there's a bull market on. So we are today probably the most expensive market in the world among all the major stock markets. Having said that, the market phases are a mixture of things. It is not just standalone valuations. It is valuations, it is relative valuations, and it's earnings growth. It's a mixture of all three. So you may have situations where you are not as expensive as some other market, and therefore money flows in, or you're not as expensive as debt markets, and so on. That is all part of relative valuation. Similarly, if your valuation is low and the earnings growth is lukewarm, you still may have a bull market because the PE is simply too low. So it's a combination of factors. So when I was in INAM, I had done a couple of strategy reports on the qualitative aspects of how to recognize which phase you are in and so on. So that paradigm still stands and is pretty useful even today. But this time what we've done is basically use quantitative factors to figure out whether you're in a bull market or already reached a bubble. So the first set of factors is obviously about valuations. So what we've seen is basically we've taken the last 20 years of bull markets, and the bubbles of the last 20 years, the four bubbles have been there. All four have been due to some international event. So the bubbles are pricked. Rather, the bubbles are not caused by international events, but the bubbles are pricked by some international event. And part of the reason has been the fact that your FIs are very important to India's economy, and we are a twin deficit country. So which is why what happens is once the bubble pricks, then the INR also sort of swings out of place and it becomes a vicious cycle. So we are not as vulnerable to FIIs now. But having said that, you are still in a phase where even though you are pretty high in terms of valuations, you are below the norms for relative valuation compared to your own history, which is if you take the last 5 years standard deviation, one standard deviation, if you take relative to emerging markets, and if you take relative to US markets. So we've established in our report that compared to the last four bubbles, we are nowhere near the same level of overvaluation as we were then in these factors. So that is one set. The second set of factors are to do with momentum indicators, like advanced decline lines, new 52-week highs, and so on. So again, obviously in a bull market you'll get a lot of 52-week highs, but in terms of new 52-week highs or AD line and so on, you are nowhere near the previous view. Then there is what is known as a fear factor. Fear factor is basically how much of money has moved from equity into liquid funds. There also there is no alert. Finally, what I have not put in the report because it's very difficult to quantify is narrowing of the rally. So if you look at the last few days, normally you take a 1 month period, you'll notice that, there has been no pattern in what sort of stocks or which sectors move up. So, the most common has been PSU banks. But apart from that, there's no narrowing of the rally like we've had in the past, like in infra in 2008, in 2000 IT, and so on. So all sectors are freaking out. And when you look at these sectors, there's no commonality either. So it's not, defensives or cyclicals or whatever. All sort of sectors are moving up every other day. So that's the thesis that it's a bull market, but it's not a bubble. The second topic, which is important, is what from now. Because, marketing, investing is not about predicting. It is from figuring out what are the monitorables and where do we go from here. So I think in terms of the market indicators, there are 4 main monitorables now. One is FPI flows. So in that, there are 2 components. One is the US Fed rate, what happens to US recovery and the Fed rate hike, when does it stop? Second part is the China stimulus. So people got misled into going into China in January this year. Again, last month, there was a lot of stimulus in China and so on. But remember, this China is a self-goal. So even though they have a lot of, long-term problems, which is demographics and property and debt and so on, but despite that, in the short run, they can reverse their self-goal anytime, and it could flow back from India into China. That, of course, doesn't affect your FDI because the China +1 story, remains, but at least in FII flows. So these are the 2 sub-factors of FII flows that one must look at, one must monitor. Second is SIP slowdown. So SIPs today are 2 times the net MF inflows and 45% of the gross MF inflows. It's huge. Plus, you have PMS, which is about 27% of the mutual fund inflows. So it's a huge part is retail. And today, if you look at the total retail basket, the retail basket at 230 billion and 270 billion, and the MFs are equal. Then you have insurance at 230, and then you have 500 and something, which is the FIIs. So you have a massive chunk, which is retail. So the second part is whether there is an SIP slowdown or not. Month after month, we are seeing that SIPs are freaking out and touching new highs. And normally the worry is if you don't get a 1-year return. So till 1 year, there's patience because the amounts involved in SIPs are very small, about $5,000-6,000 or so.
Right.
So the second is SIP slowdown. The third is El Nino. Now, El Nino is a bit complex because along with El Nino, some new developments, we keep hearing nowadays, the Australian Met has come out with SOI and IOD, with the inter-ocean dipole, Indian Ocean dipole. So I think the combination of all these factors, we'll have to figure out whether September will be okay or not. So far, it seems okay, this thing. So that is the third part, which is the El Nino. And the fourth is the results of the 4 major state elections. So I think these are on the overall markets.
Sure. So I want to follow up, that with the quantitative study that you all have done as well over the previous few bull and bear phases as well when it comes to sectoral rotation. And of course, the key takeaway from here, from what I understand in the report, is that very few sectors sustain their valuations, expansion or contraction in the subsequent phase. So based on that and your observations in the recent most bull and bear phase, so what can we expect? And of course, you also putting in the caveat here that this can be used as an alert, not necessarily a predictor. But so what sectors can we focus on based on some of the observations that you made over the recent phases?
See, one must be a bit alert in this because this is not about earnings growth. Neither is it about stock prices. It's only about valuation compression or expansion. So what we've said is if we take the last 20 years, those in bull phases where the valuation has expanded the most or contracted the most usually reverse. Not all of them, but many of them reverse in the next phase. So if you look at currently in the last 1 year of the bull phase, sorry, the sectors which have done phenomenally well in terms of valuation expansion have been metals, cement, capital goods, textiles, and bank PSUs. So that's where the alert is. So our call on this, on metals, is that the cycle will now improve because China coming out of its economic issues and so on, and hopefully the US recovery too, and steel prices are basically just above break even in China. And aluminium, there are new uses happening because of renewable energy, like in solar, wind turbines, and so on, and also in EVs, electric vehicles. So metals, what will happen is there was a cyclical high post-COVID and pre-Ukraine. So the outlook will improve.
Right.
But the multiples will cool off because, it's opposite for cyclicals.
Right.
Cement is exactly the opposite, which is basically the multiples expanded coming off a cyclical low because of input cost inflation. And now the multiple will contract as the cycle stabilizes.
Sure.
What is capital goods? And this is where we have to be a bit careful. The results have been a bit weak in capital goods. Private sector capital goods have not taken off. The government has sort of front-ended all its capex this year, and the hope is that capital goods will take off. And this is a multi-year hope, not just for this year. The order books of all the large private sector these things have been fantastic.
Right.
So the hope is still strong. So what we are saying in capital goods is the multiples are likely to contract because the multiples, because of the hope, has been there for last quite a long time. So I think the multiples are already at a very high level. Now the earnings growth has to come in and prove itself. Next is textiles. Textiles we don't rate. We don't have coverage, but the FTA is being signed and the US recovery, whenever it happens, these sort of things will help textiles. And finally, PSU banks, the last 2-3 days, of course, have just broken out. But otherwise, we still find value in PSU banks. So that is among the top, the ones which expanded the most. The ones which contracted the most were consumer services, power, chemicals, and IT. Out of which I think the important ones are chemicals and IT. So let me talk only about those two. In chemicals, the China plus one continues. Domestic demand is also freaking out, but the multiples have not contracted. Only the earnings growth has fallen.
Right.
So we expect now that the multiples will, at least not expand.
Right.
And
Right.
on the chemicals.
Right.
On IT depends now on recovery. Depends on two things. One is US recovery, and the second is that the next wave of Indian IT in AI training.
Right.
When will that start? So I think these are the two triggers for large cap IT. Mid cap IT. Let's wait for the previews to come in over the next 10 days. They look fairly expensive now.
Right. So speaking of mid caps, I also want to talk and address the mid cap rally. The question really is that is this area become very frothy? How do you see valuations here? And what would you do? Is this rally justified at the moment?
So it's obvious that mid caps are overvalued by any measure. While we've used PE in the strategy report, another way to look at it is to look at price to book, and you're way above. So that's understood that you're way above the standard deviation zone. Having said that, there are three things. One is mid caps go up under one of two conditions. One is when there is GDP surprise, which we don't expect. then the smaller companies do better than the larger companies in both volume and margin. The second is when there's a severe discount. Again, not the case.
Right.
So there is no case for mid caps to take off. Having said that, mid caps are now the single largest part of mutual fund AUMs.
Right.
So that is only if I take, small cap and mid cap as a this thing. Now, if I take flexi cap also, there's a lot of mid cap in that. So if I take the total quantum, it's huge. Plus you have, apart from mutual funds, you have retail and so on. So mid caps, in my mind, I don't think they're going to crash.
Right.
They will take a pause, because if you look at the mid cap earnings, the FY25 earnings just take off.
Right.
FY24 is not good. So FY24 mid cap earnings are just above the Nifty earnings, so it's not much. But FY25 is, I think, when it takes off. Right. Number two, I think a lot of people look at the price to order book type of mid caps, which is, a lot of the capital goods and so on, those related sectors. But that's not mid caps. I mean, mid caps is a huge universe. And if you look at if you look at your mutual fund portfolio and the mid cap schemes, and you look at the top 10, you'll find hardly any, stocks in the institutional portfolio, which is dangerous. So a lot of these bubbles in mid caps are possibly in the retail. Maybe in PMS, I don't know, because we don't get their portfolio. So maybe in those, but institution is not so alarming. So I think mid caps will take a breather as large caps in banking, auto, and all that, sort of start again freaking out. That is the cyclical part of it. Not so much the defensive, more the cyclical part of it. I think the large caps will now, do better because the bull market is on.
Right.
But mid caps will not crash. Only thing is you have to be careful what you own personally.
Right.
You own any of these, things which don't make sanity checks.
Right. Right. Okay. Well, to just take on the point forward from what Mr. Chakraborty was saying, suggesting that mid-cap earnings growth could take off from FY25. And among the sectors mentioned here is, of course, logistics, FMCG, cement, durables, consumer services, media, and textiles. But, Mr. Chakraborty, I also want to take stock of the rural economy, which has been a little bit of a pain point of late over the past, a few quarters. How do you see the rural economy develop going forward, especially keeping in mind that we are in election year? And on the other hand, we also have, the expectations of an unfavorable weather conditions, El Nino and rainfall at this point. What's your view here?
So, obviously, El Nino is a major fear. It affects, if it were to affect us, it would affect about 28% of the total NSE 200. It sounds a very large number, 28%, but it's not that everything will be affected equally. Some, for example, the smaller NBFCs, which is more rural related, or smaller loans. I think microfinance, all those parts will be affected more than, say, PSU banks will not be affected. So it's a large swath, because you have auto, you have NBFCs, you have banking, you have all sorts of sectors which will be affected by rural. But they'll all be affected in a very small way. Part of the problem is also not just this, but also the water reservoirs are low. So even if the rainfall is good now, your Rabi seems to be in a little bit of problem. Terms of trade are also not very good. And with the winter coming, oil prices might rise, the way Saudi Arabia, Russia are freaking out, oil prices may remain high or may even inch higher. And that is the biggest input cost for rural India, is oil prices. Because, fertilizers, inputs, everything else. So it is a problem. On the other hand, there is competitive dole-outs happening by the various state governments. And both the central government and the state government are going to do things to help rural India. In a pre-election year, we've shown in our strategy report, we've shown that if there's high inflation, you don't win elections. So it's not that inflation is the only thing which affects inflation, but it definitely means that if you don't control inflation, there's a chance of losing elections.
Right. Right.
You all know, for example, the various promises made by various parties in, Telangana and so on. So, Madhya Pradesh, all these, 4 states. So, so maybe there'll be a lot of relief which will offset that.
Sure.
It's too early to say.
All right. All right. So I'll move on to the section where you actually do mention, a handful of stocks which could potentially double over a period of time. So I understand that you won't be able to talk about stocks specifically, which is why I'll just take a few names. But there is a little bit of a sub-theme as far as these stocks are concerned. So we have the names like Escorts Kubota, Bharat Forge, TVS Motor Company, Uno Minda. So what are the factors that you are looking for as far when it comes to picking some of these names without, of course, specifically talking about these names? And how do these feature in your list of doublers?
So I don't think you should read too much into the sector.
Okay.
Because when you're doing a bottom-up exercise, it is what comes up as a bottom-up exercise.
Sure.
So it is not reflective of any great thing happening in auto. Because if you look at it also, Bharat Forge is more defense than auto.
Right.
Escorts is a lot of exports in terms of the story. So each of these are completely different types of plays. I think the way we've done this exercise is we've asked our analysts to take stocks which are more than $2 billion market cap. So you leave out all the small caps. And where the EBITDA CAGR is more than 26%, so which is equivalent to doubling in 3 years. And when there are a few more conditions. One is where the PE is not too high,
right.
that it will be derated, because that will take away from your doubling.
Right.
So for example, you find 2 of the stocks here, Astral and Trent, you'll find as high PE, but we back tested. And if you compare to the last 5 years PE and the last 5 years EBITDA CAGR and compare that with the future, it seems in line. So there is no, wherever there is any severe P rating of P which is possible, like if it's a commodity or cyclical or whatever, we've avoided those. And finally, we've said where the near-term target price upside is positive.
Right.
Because obviously, if it's negative, again, just like P derating, you're taking away from it. So that's how we've come to our, cricket or football team, whatever, of 11 players.
Okay, understood. So final question then, and this is on capital expenditure. We know that, once again, the elections will play, or in that case, have already played a little bit of a part in, pardon me, public sector capital expenditure. What has been lacking over the past few years is private sector, which has been happening, but it's just been trickling over. Do you see an improvement? And when can CapEx show meaningfully in corporate earnings going forward?
So I think that will also show up really in FY25.
Right.
FY24, there may not be too much of it.
All right. Well, Mr. Chakraborty, that is all that I have for you. Thank you very much for this insightful conversation. And of course, this great report that we have gone through as well. Thank you so much for your time. And thank you for joining us. And with that, this is me, Agam Vakil, signing out from BQ Prime. Stay tuned. Lots more lined up.